going on, everybody? Thursday, July 8th. Markets pulled back a little bit. I'm going to call this the slow drip market. The slow drip, and I'll tell you why. Fiscal flows. You know, I check them every day. That's the core of everything. That drives everything. The deceleration in fiscal flows is very modest. It's very slight. So if you think of it as just a slight leakage to the economy, right? I've used that analogy before of the swimming pools, you know, with the water flowing into the pool from the government pump and the water level is rising. Well, now it's rising at a slower rate. And yesterday I talked about how, you know, that might not even be consequential, because if you look at the deficit, it's still like 2.27 trillion. I mean, that is a serious, significant deficit. That is, remember what I said, how you should phrase or how you should call the deficit. You shouldn't say a deficit. That has a negative connotation, okay? When people hear that, they freak out, oh, the deficit. Call it net transfers. Transfers from the government to the non-government or the economy, us, okay? Those are income transfers, all right? You shouldn't say deficit. And when people start to talk like, you know, when they hear that word, they freak out because deficit has a negative connotation. Anyway, that's still a big number, but like I said, it's down like 140, 150 billion from last year, where we were last year. And the average daily flows, okay, if you think of that water pipe going into the swimming pool, the rate of flow has slowed down a little bit. You know, it's not shut off, it's not sucking water out, all right? But the rate of flow has slowed down a little bit. And again, maybe that's not consequential because it's still a significant rate historically. But when you look at it year over year, there's definitely a slowdown. And when you look at the rate of flow now compared to, let's say, like back in April or March, it has slowed down. So I call this the slow drip. And I think it's going to make it difficult for the market to make new highs in a sustained way. Like what we've been seeing is like, you know, it'll make a new high and then it kind of drifts back down. And I think it's kind of rolling over here right now because of the slow drip. And it's funny because a couple of weeks ago, I did a video that said, you know, the market, I think it was the title of the video, you can go back and check it. It was something like, you know, bull markets don't necessarily have to end with a blow off top, because I heard somebody say, like, you know, there's only one way a bull market could end, and that's a blow off top. Like, bull markets don't die of old age. And the terminology, all that kind of figurative language, old age, blow off top, that's just silly. I mean, when the driving forces of the economy, when those conditions, when those basic conditions, which are determined by, you know, things like fiscal flows, when those things shift or change or slow down, yeah, the market, you know, it's gonna eventually reflect that and come down. There's no such thing as a blow off. There's no such thing as a, you know, all this crazy, you know, what was the other thing? Blow off top, die of old age. You know, when people start talking about that, that is like a sign. When you hear people speaking in figurative language like that, when they're just like, you know, metaphorically, that's a sign that they really don't understand it. They don't know what they're talking about. And they'll use that language, you know, to make it sound fancy or interesting or insightful, when in fact it's not. All right? Here's another thing that I noticed today in the Fed's weekly H41 release. Reserve balances in the week ending just yesterday, okay, July 7th, up 345 billion. That is the biggest 1 week increase in 4 months, all right? And it I think it marks the bottom because last week they got reserves down to like 3.5 trillion. They're like almost 3.9 trillion now. And remember, what's going on here? All of these operations, well, I shouldn't say all of them, but primarily the reverse repo operations that the Fed has been conducting, right? And I've been talking about these. These are temporary operations, all right? They were intended to help the banks, alleviate them from some of the reserve problems that they were having, all those massive increase in reserves, but they're temporary operations, okay? It's not like treasury sales. Treasury sales can permanently drain reserves, all right? What the Fed was doing with reverse repos were temporary operations, and now the reserves have come back onto bank balance sheets. So what does that mean? Interestingly, and this makes a lot, to me this makes a lot of sense, the dollar bottomed out when reserve balances peaked back in May, early May, around May 5th, May 12th. I got to go back and look at the calendar. If you look at the dollar index, you could see, it was kind of like bouncing along a bottom around early May when reserves peaked, and then the Fed drawing down those reserves, the dollar started to rally, right? They're sucking out dollar balances. Now it looks like reserves have bottomed out and they're starting to go back up again. And I think probably it indicates we're near some kind of a top in this dollar rally, the dollar strength that we have seen. And I think going hand in hand with that would also be a gold price increase. So we'll see. And again, these are short-term fluctuations. So, you could get a dollar sell-off here for the next few weeks, and then we may get into another situation again. I don't know, like if the Fed starts engaging again in these, massive reverse repos. But I'm just bringing to your attention what has developed. It looks to me like we've seen a bottom in reserves for the time being. They're starting to build back up again. Treasury today said it was going to cut back on its bill issuance. Bill issuance is another form of reserve drain, okay? Yellen is cutting back on that. Why? Because obviously she sees the debt ceiling coming up and probably realizes politically that it's not going to get lifted or suspended, at least until probably the end of September, when they're talking about a full budget for 2022 fiscal year. So I've been getting a lot of thank yous on my bond call. People have done very, very well on the TLT recommendation. I don't know if I put that out here specifically on the videos, but I think if you've been following my videos, that way back, in March, when everybody was hysterical about rates going to skyrocket because of inflation and this and that, I was like, whoa, pump the brakes on that idea. All right, MMT 101, bond yields are going to be going down. And that's what happened. Anyway, that's it for today. Don't forget, go to my website, pitbulleconomics.com. Sign up for a 30-day free trial of MMT Trader. I'll see everybody tomorrow. Bye.